policy series. I'm your host, Nate Smollett. Today, we'll focus on the ECB banking supervision priorities 2025 to 27. The ECB supervisory priorities are the key focus areas set by the European Central Bank to address the most significant risks and vulnerabilities facing European banks over the next 3 years. The priorities matter because they guide supervisory actions, they promote consistency and effectiveness across the euro area, and help ensure that banks remain stable, resilient, and able to support the economy amid evolving risks. At the EBI, we're fortunate to have drawn the interest of a distinguished panel to carry us through all this in greater detail in the next hour. And before I go into the introductions of today's speakers, who will shed some more light on this topic, I'll quickly provide the format of the webinar. The webinar is planned for an hour. The panelists shall steer us through the discussion for about 45 minutes, which should leave us with sufficient time for the Q&A discussion. And in this part, the audience is also welcome to pose a question in the Q&A tool, which I will then include in the discussion. Now, moving on to the panelist presentation. As our keynote speaker today, we have Mario Quagliariello. Mario is the Director of Supervisory Strategy and Risk at the European Central Bank, Banking Supervision, in charge of the SSM strategic planning, risk assessment, and the second line of defense function. Before joining the ECB, Mario spent 10 years at the European Banking Authority, latest as a director of the Economic Analysis and Statistics Department. He previously served as a senior economist at the Banca d'Italia and holds a PhD in economics from the University of York. Mario will have a presentation on the risks to euro area banks and ECB banking supervision priorities. Our next panelist is Björn Elfstrand. Björn has extensive background and knowledge of the financial industry in Sweden and the 3 Baltic countries. His career spans 33 years at Swedbank, where he was responsible for the most business and product areas and Swedbank's branch network in Sweden. 8 years as a member of the Group Executive Committee, and the last 3 years in Swedbank as chairman of the supervisory committees in Swedbank Estonia, Latvia, and Lithuania. Currently, Björn is the CEO of the Swedish Savings Banks Association and has been for the last 3 years. Björn's presentation will focus on the Swedish Savings Banks' challenges to handle the increasing regulatory burden as small non-euro banks. And to close our lineup, I'd like to welcome also Martin Switajski. Martin is heading the ECB EBA office at the German Savings Banks Association, representing the interests of Sparkassenfinanzgruppe, which consists of more than 350 credit institutions, 8 of which are directly supervised by the ECB. He's been with the German Savings Banks Association since 2007 in various risk management and regulatory roles and served as Chancellor to the Executive Board. Martin will focus on how banks can align with the ECB banking supervision priorities and on the importance of engaging in a supervisory dialogue. Now, a warm welcome to our panelists once again, and I'd like to invite now Mario to take the floor to provide an overview of the ECB banking supervisory priorities. Thank you.
Thanks a lot. Good morning, everyone. I hope you can hear me and see the slides. So what I will do is for the next 10-15 minutes to go quickly through our risk assessment and the priorities for the cycle 2025-2027. This is a good moment for us because it's also when we have started the discussion for reviewing the priorities for the following cycle, so 26-28. But let me start first with the outline for today. I will quickly go through the macro financial environment. Then I will move to the key risks and vulnerabilities for the banks in the euro area, and I will close with a reminder of the priorities for this year and for the following. Now, if we start from the macro conditions, I would say clearly we have a mild, modest recovery in the forecast of the ECB. The forecast has been reviewed downwards because of the geopolitical risk. And you can see that while there is some recovery, the GDP growth is not expected to be higher than 1.5%. So to some extent, compared to a couple of years ago, expectations better than the hard landing, but still not too exciting. On inflation, the expectation is to have some, let's say, challenges going forward, but still inflation reaching the target of 2% in 2026. Clearly, all the forecasts are very much affected by the uncertainty, especially on geopolitical developments. We have still the ongoing Russian war in Ukraine, uncertainty on the evolution of the conflicts in the Middle East, and also in other areas. And of course, the issue of the trade wars is very relevant these days. And this, of course, has been reflected in financial markets. To some extent, there was an increase in volatility. This was not unexpected, to be honest. When we published our priorities at the end of 2024, in our risk assessment, we were mentioning the valuation of financial markets, the risk of repricing, and this has been indeed the case in the past few months. Still, if you look at the European banks and compared to the start of the year, they've been performing well, with, of course, a big hit during the initial announcements from the US administration of the tariffs, but then also with some recovery. And this has been very much driven by the good profitability over the past few cycles. Also, in this case, again, the whole uncertainty is pointing to downside risk. So this is where we need to be particularly careful and monitor the evolution of financial markets. Moving to the risks to banks, I mean, the way we think about risk is looking at the potential external triggers and then which are the vulnerabilities in banks which can then affect our banking sector. So starting from the business model, I mean, here we are coming from a few years of very high profitability, very large extent to the evolution of interest rates. If you look at the chart on the right, you can see the increase of the return on equity between 2022 and 2023. And I think what is interesting is to look at the cascade, I mean, the main drivers of then the evolution of return on equity in 2024. 2024 has been characterized by less beneficial interest rates for profitability in banks, so a stabilization of the net interest income, but at the same time, there has been a significant contribution of non-interest income sources, especially fees and commission, but also to some extent trading income. Now, the analysts are still optimistic on the perspectives for profitability 2025, but we want to be on the safe side because there are elements linked to the evolution of interest rates, but also the amount of provisions which can be affecting the profitability going forward. Also, and this is my last point on the business model, the progress made on profitability are coming to a very large extent from the earnings side. And as I said, to a certain extent, exogenous from banks' behaviors, while the cost structure remain still challenging for several banks in the euro area. Needless to say, there has been a lot of announcements on potential acquisition mergers, and this has been also beneficial in terms of the valuation. And this is also something which is not, let's say, can be one-off effect on the valuation of the banks. Moving to capital adequacy, I think if you look at the chart on the right, it's very clear that there has been steady progress over the past 10 years, looking not only at the capital ratios, but also at the amount of capital in the banking sector. Of course, in the last cycles, the increase in profitability has been helpful, because notwithstanding the dividend policies of the banks, there has been also a significant amount of capital stayed in the banks, which is a positive development. And we wait for the full implementation of the Basel Accord as a further element for strengthening the capital position and the resilience of the banks. In terms of issuances, no issue, actually relatively favorable conditions for the AT1 and Tier 2 capital instruments. On the planning side, our point to the banks is always that even if there is clear resilience in terms of the level of capital, it's important to look at adverse scenario which can then affect the capital position. So be cautious, especially when there are decisions to be made on share buybacks and distribution of dividends. Asset quality, also overall good picture if you look at the track record of the banking sector over the past few years. NPL ratios remain low. Still, we see some early indicators of deterioration. So far, they've been mostly in specific sectors, commercial real estate, small and medium enterprises, which still are quite important for a number of banks in the euro area. Also, what it is different compared to the past is that the larger increase in NPL has been recorded in countries which traditionally have been doing better in terms of asset quality, which also is an important element to look at the geographical concentration of these kind of risks. Once again, and sorry for repeating the concept, the downside risk is relevant. The trade tensions may affect the economic recovery and therefore asset quality for the banks. Not only the banks are directly affected towards the vulnerable sectors, but more generally the banks because of the second round impact. Liquidity and funding overall, again, quite resilient. If you look at the liquidity coverage ratio, but also the NSFR, they are well above the regulatory requirements. And this has been confirmed notwithstanding the decline of the excess liquidity in the system because of the change of the monetary policy stance. Deposit funding costs are also decreasing in line with the decline of interest rates. And there is no issue at the moment on the deposit base, which is actually increasing. And also the wholesale funding, the conditions for the wholesale funding improved in the past year. One issue to mention is though the increased level of debt in of public debt in several jurisdictions, which can have an impact on the banks themselves. So the evolution of the cost of funding, the sustainability overall of the private and public debt is something to be monitored constantly. Moving to operational resilience and perhaps also accelerating slightly because I think my time is almost over. If you look at cyber, this is one of our main concerns for the banking sector, because if you look at the SREP scores over the past few years, operational resilience is where we feel there are more vulnerabilities in banks, and also because, to be fair, is where the banks, the authorities, they need to learn more on how to respond to this kind of attacks. Now, if you look at the statistics, they are not too bad because there has been an increase in 2024 on the incidents related to operational risk, but no increase actually as a decrease in the aggregate losses. But we know very well that these events are one-off, binary, and can have a big impact. So this is not a reason for any comfort. In terms of the kind of incidents, there is a big chunk coming from the distributed denial of service, but there are also increasingly incidents coming from problems in third-party providers. And we have always emphasized two kinds of concerns in terms of operational resilience. One is the outsourcing of critical functions, which is becoming more and more relevant. This is something that has been always done, but one thing is not to outsource the cleaning service. One thing is to outsource the cloud computing. So even if the safeguards are the same, the intensity of the effort of the banks, but also of the supervisors should change. We know that several providers are not in EU countries, which is posing additional challenges for the contractual conditions, but also for the oversight. What is helpful is the entry into force this year of DORA, because this would put will provide us, let's say, a richer toolkit for supervisors. There will be some oversight on some of these providers. There will be more information coming from the incident reporting, and also there will be threat-led penetration testing, which would help understanding the vulnerabilities, but also the strength of some institutions. I mean, on digitalization is a bit of follow-up on operational resilience. There is one element which is several banks are using digitalization as a way for improving business model, for working on the cost structure. It is important to have the right investments in digitalization, and it's also important to have the strategy and the internal awareness of the risks. And this is relevant in general, but if you look at the evolution and the increasing use of artificial intelligence, this is also where we need to learn together with the banks the best way forward. I mean, so far, what we understand is that banks are using artificial intelligence mostly for streamlining, making more efficient some basic processes. But let's say when we move from this sort of office automation use to decision making is where I think the safeguards should be stronger. On climate, I would just mention that if you look at the current evolution of how far we are from the target of the Paris Agreement, it is clear that there will be an increase in physical risk, which we have seen, I would say, constantly in some countries over summer with the fire, over winter with the flood, and also of transition risk. On transition risk, banks are requested to have prudential transition plans, and this is where probably we'll focus our attention going forward as well. I will quickly close with the supervisory priorities we published last December for this cycle, and you can see that we try to bundle the different topics into three big headlines. The first one is the immediate response to macro financial threats and geopolitical risk. And here we have one element, which is credit risk management, especially the treatment of novel risk in IFRS 9. We have operational resilience. I mentioned this already in terms of risks coming from outsourcing, but also cyber attacks. And then more generally as a cross-cutting issue, looking at the awareness risk culture for banks when they deal with geopolitical risk. The second category is more looking at what has been under supervision for many years with clear request to banks to remediate, and when this has not been done in a timely way, we will start enforcing our recommendations or decisions and escalate if need be. And under this headline, the two key topics are climate and also risk data aggregation reporting. And the last part is where instead we need to learn more. We need, and banks need more time to adjust under digital transformation. So is mostly area where we would like to have more information, understanding better the shortcomings in banks and support improvements over time. Now, if we look at what we can expect from the next cycle, I would say first we try to have priorities which are as stable as possible. As you have seen, the cycle is 3 years, so we try to roll it out, but it's important also to keep it stable. So my feeling is that risk data aggregation will remain a key topic, climate will remain a key topic, and operational resilience at large will remain a key topic. And I think also our focus on remediation compared to risk identification, I think will stay there. It is important, this has been the lesson from the SVB case, that when we find issues in banks, we say push bank to remediate as soon as possible. If this doesn't happen, we can move in the escalation ladder. And with this, I will stop. Thanks a lot.
Dear Mario, thank you very much for starting us off with such a comprehensive view, and really beneficial to have this in our awareness going forward. And I would now like to invite Björn to share, his views on the Swedish savings banks' challenges to handle the increasing regulatory burden of small non-euro banks. Björn, the floor is yours.
Thank you. Well, as you said, Sweden is a member of the EU since 30 years back, but we are not in the euro area. That means that we still have sort of authorities from the Swedish FSA and the Swedish Riksbank, the central bank, that are regulating us and following us. And that means that there are some deviations from the European sort of agenda to some extent, although that I can conclude that both the Swedish FSA and the Swedish Riksbank, they follow more or less what is happening in Europe. It may take a bit longer time, but at the end of the day, the things that are being discussed and the policies that are decided in EU will end up also in Sweden. We have a specific, as the savings bank, specific legislation, a savings bank law in Sweden that affects us to some extent. But we are savings banks with local presence, still with the retail banking sort of business model, focusing on the branch network, the individual meetings with the customers, and a very strong digital platform that we develop together with Swedbank. And I think that is important when we're going to talk about cyber risk and other types of risk, because most of the things that we do and that we have in the savings banks, we develop together with Swedbank. So we are running on the same platform, and we share sort of the same views regarding risk and risk appetite. The savings banks in Sweden are rather small. They are stemming from the smallest savings bank is 12 FTE, and the largest is 600. That means that there are challenges regarding how to absorb, for example, cost increases, general inflation, but also all the cost increases that come from the effects from the war in Ukraine or whatever it is. It ends up in the cost structure, both in Swedbank that we pay for, but also directly. And that is a main challenge for the savings banks that has led to focused on mergers. We have ongoing mergers more or less all the time. We have today 55 savings banks from the northern part of Sweden to the southern part of Sweden, and they are trying to get scale by merging, but also to open some new branch offices. The fundamentals regarding sort of earnings and cost are rather good in the savings banks. On general, we can see that for all the savings banks together, we increased our profits with 10% last year compared to 2023. The average return on equity is 11%, and the cost-income ratio is 0.4. So it's the challenges in the savings banks are not primarily sort of in the earnings capacity or customer satisfaction or in the business model. The challenges are about proportionality. Of course, we get a lot of help from Swedbank regarding new regulations, and we also work intensively at the Savings Banks Association with these issues to help the smallest savings banks primarily. But of course, it is a huge challenge to absorb all these new regulations. And that doesn't mean that it is something wrong with the regulations. I think they are good. They are good for the banks. They are good for society. They are good for the environment, etc. But it is more about how much you can ask for a small institution to handle in a short time frame. Because I think that is most of the challenges right now, that there are an enormous amount, to put it that way, of regulations in many, many areas that has to be implemented in a very short time frame. And that means that although they get support, that also has to be absorbed in the savings bank, so they actually can fulfill what is expected from them. I also think that there is a question about the granularity in sort of the new legislations, what is expected. There is a challenge regarding response times, time frames. If you have a GDPR breach or a PSD2 breach, you have like 72 hours to report, a full report to the Swedish FSA or other authorities. It doesn't matter if it has happened during a Saturday or Sunday, whatever it is, it's 72 hours. So I think from a savings bank's perspective, I think that everything that is happening is fine, but the expectations are a bit too high in some areas. I think I'll stop there as the introduction.
Many thanks, Björn. I think it's always very interesting to hear from a non-Euro jurisdiction on their views. I would like to now move to Martin. He will focus within his introductory remarks on how banks can align with the ECB priorities, and also highlight some of the importance of engaging in supervisory dialogue. Martin, the floor is yours, please.
Thank you very much, Nace, and many thanks also to the EBI team for the organization of this event. And thank you very much, Björn. I fully support everything that you just described. And I think it appears our experiences within and outside of the SSM are very much the same, be it the granularity of requirements or the time criticality. And also, grazie mille to Mario for his keynote on the SSM priorities, which was very helpful to get insights as to the motivation of the ECB behind the priorities. And I would also, first of all, like to give a very short introduction to the Savings Banks Finance Group. As you already mentioned, we have around 340 LSIs and 8 SIs within our group. We have a rather strong position in the German market. Our members are all independent, but bound by a institutional protection scheme. And in our case, the smallest of our members has a balance sheet of around 270 million euros, while the biggest member has around 360 billion euros in assets. And I think that goes to show that our group is quite diverse. And so we always look at supervisory expectations from the perspective of both SIs and LSIs. And I would also therefore like to reflect a bit upon the priorities from the standpoint of a diverse and cooperative banking group. And where possible, I will try to provide some very humble insights as to what SIs and LSIs can do to align with SSM expectations. All right, now we internally like to refer to the ECB's priorities as the 3 Rs: resilience, remediation, and reinvention. And in my brief statement, I would like to cover the priorities of resilience and reinvention. And yeah, let's start with resilience against macro shocks. I think as a general observation, and that's also something that the numbers that Mario just presented show, I think that the European banking system has actually shown quite remarkable resilience to external shocks, be it the COVID pandemic when the ECB and the NCAs and the EBA published their COVID-19 toolkit, and in particular reacted in a very coordinated nature to the crisis, which helped banks also steer through the pandemic. And I think another even more important external shock that we have seen was, of course, in March 2023, when Silicon Valley Bank collapsed, which was the largest bank failure since the global financial crisis. And as we know, in contrast to that crisis, the banking turmoil in the US created little to no repercussions in the EU financial system, which is quite remarkable, I think, if you consider that the preceding shifts in the monetary policy have been very similar across the Atlantic. And so therefore, I think Europe could actually do with a little more self-esteem regarding its regulatory setup and also the condition of its financial sector, instead of perhaps constantly longing for reform and for more detail in banking regulation. But still, of course, we do agree with the ECB and their declaration of external shocks as one of the top priorities until 2027. And in our group in particular, we're a lot focusing on the role of savings banks as part of Germany's critical infrastructure. And of course, we're not only seen as financial service providers, but also as economic stabilizers. And that was already the case during the pandemic. It was also the case in 2022 when we provided more than 300,000 bank accounts for Ukrainian war refugees. And today, of course, the global situation is obviously very tense with all kinds of threats to economic actors. And here, the key focus for our banks is to understand how these risks, how these geopolitical risks might affect operational functions on the ground, such as payment systems or cash supply or communications. And one example of how we're doing this, our members are doing this, is engaging with law enforcement and military experts For example, this includes exchanges on the so-called O-Plan DE, which is the operations plan Germany by our Homeland Defense Command. And the objective of this plan is to ensure that essential functions, including financial services, are protected. And looking at this and exchanging on this has actually helped a lot to translate the rather abstract shock scenario to an operational impact on the bank level. And in that sense, this engagement can be a very helpful input for scenario analysis and also for stress testing, and lead to insights on risk drivers, early warning indicators, and so on. And another example for how we deal with external geo risks, geopolitical or geographic risks, is in the area of ESG, which Mario also mentioned, the C&E risks. Here we have created a central data hub for physical risks, which is linking external climate data with individual business regions. And that actually helps to identify regions that are affected by, say, flooding or extreme weather or other physical risks. And instead of just using these data for taxonomy reporting, they will eventually feed into risk management, scoring, stress testing, and so on. So this group-wide cooperation, setting up a data hub, will actually help banks to align with ESG requirements and to better identify physical risks. Now, as I said, I also want to say a little bit about the third supervisory priority, which is reinvention. And here, our savings banks have a 200-year-long history, and they can tell a story or two about reinvention over this period, of course. And today, we are providing digital services that are tailored to the needs of our customers. And we have largely taken a sandboxing approach when it comes to developing innovations, and have made very good experiences with this sandboxing approach. Even at our association level, we have set up a digital lab, and all the related risks from digital innovation and digitization, they are managed in a group-wide framework and in close interaction with our group IT provider. And also in this context of reinvention and digitization, actually the ECB's 2024 report on digitization was and is still very helpful. And our first advice to banks is always to look at this report and the ECB's observations, such as formulating a well-articulated digital strategy, be it standalone or embedded in the business strategy, or setting up a talent strategy to ensure digital literacy. Okay, so lastly, and also for the sake of time, I would just like to give a few more general points on how to perhaps translate ECB priorities into added value for the individual bank. First of all, we are hearing good feedback and making good experiences on performing ECB style self-assessments, so as to mimic the JST expectations. Then, of course, like I said, make use of the ECB reports and other documents that help banks to understand the ECB expectations. But most importantly, the last point is really to, I think, make use of supervisory dialogue whenever possible, and to engage with your JSTs and your NCAs. So thank you very much, and I'm looking forward to the Q&A now.
Thank you very much, Martin, for all your comments and examples provided. I think these were very, very relevant. But this, so this concludes the first half of our webinar. Now we're moving more into an interactive sphere. I would like to ask our panelists a few questions that complement the presentations that we've seen, but I would also like to invite the audience to start thinking about your questions. You know, you have the opportunity to ask our panelists in, I would say, the last 10 minutes of our webinar, any questions you may have that are related to the topic of discussion today. And I see that some of you have already front-loaded some of the questions, which is great to see. But as I said prior to that, I would like to ask Mario a question first. A lot has been, you have presented a very comprehensive view of the risks, but what is probably very interesting as well for our audience is what goes behind the scenes, when the ECB is preparing and developing the priorities itself. What is the exact internal process, and what kind of analysis is undertaken that leads toward determination of the priorities as you have presented on the last slide? And if I could expand on that, it would be very interesting to hear, how do you measure the effectiveness and the delivery according to the plan? Mario, please go ahead. The floor is yours.
Thank you. Thanks a lot. First, I would try to address your question also, if I manage to incorporate one of the questions in the chat on the, let's say, other risks which I didn't mention. I would say the process in itself is not a very, let's say, perhaps exciting topic for a seminar. You can see, I think, on my back part of the chart explaining the internal process. I think what is more relevant here is how we engage and we have dialogue with all the stakeholders for coming to our decision. The first element is clearly risk assessment. We think always in terms of which are the risks in the sector, actually, which are the potential shocks coming from the economy, from financial markets, which are the vulnerabilities in banks, and therefore which are the riskier aspects we want to address. So in terms of the risk assessment, this is a key part of what we do, and we are actually updating these in basically daily basis almost. But when we come to the peak of the preparation for the priorities, we have a very strong engagement, first of all, with our colleagues in the JSTs, in the on-site teams, also our colleagues in the central bank side, because our colleagues in financial stability, monetary policy, they are sort of very helpful for giving us the forecast, the framework, the expectations. We have a very strong engagement with the banking industry. Every time we start our cycle, we have at least one meeting, not to mention all the bilaterals with the associations to get their own views on the risks in the sector. And we also engage regularly with market participants other than banks. We have one group which is chaired by our chair with all the market participants, investors, analysts, credit ratings, etc. And this is helpful because then we can hear from everyone their views on the outlook. And I have to say, this is something that is, I think, a bit less common in Europe compared to what the UK is doing, etc. Not this concept of market intelligence. Sometimes in supervisors, the feeling is we know better. And perhaps it is true that we know better, the banks, but eventually is the investors buying the shares. So it is also important to understand better the mood, the sentiment, and have a look at these aspects. So that's why we hear from everyone, and then we make our proposal, and then is our supervisory board giving the top-down steer on what should be done. One key point, and this is also why I wanted to cross-reference the question in the chat, the SSM priorities are very important, but this is a little part of what our supervisory teams are doing. These are the priorities which are horizontally relevant for many banks and therefore for many JSTs, but there is also a very strong component in what the SSM is doing, which is idiosyncratic, is bank specific. So the JSTs spend a significant amount of time looking at the specificities of their banks. The supervisory priorities are, let's say, contribute with a bit of few flagships which are relevant for many banks, which is also why in the last cycle, interest rate risk in the banking book has not been put as one of the priorities, because we had already done some work when, especially when the cycle of monetary policy was in the tightening mode. We learned that banks were overall resilient. We identified a few outliers, and the follow-up for these outliers was idiosyncratic. So it was not anymore, let's say, a SSM-wide priority, but was still a priority for quite a few JSTs. The same goes for the internal models. I mean, clearly there is an ongoing process for the validation of internal models, for assessing material changes. We know that sometimes this is challenging for banks and is also a bit of challenge for us. We have a backlog which we acknowledge is really sort of lack of specialized resources for being able to take care of the whole requests coming from the banks. I think there is a discussion ongoing on, let's say, streamlining, making processes more effective. In some cases, some of these processes are coming from legislation. In some cases are coming from our own methodology. So we need to see what can be simplified. But this is all the daily activities routine of the JSTs. I think the priorities are really now an additional layer, which is more top-down steer common themes for all the teams. Perhaps just very quickly, other two elements. I mean, first, I like what Martin mentioned on the 3 Rs. I think we should recycle it also for our own communication. And I think you are spot on. I mean, clearly for us, the resilience element is something we don't want to compromise on. And also this element of remediation, which, to be honest, is also in the interest of the banks. It is painful for everyone to have some findings and measures open for many years. I think it's better to have clear expectations from the supervisors, quick escalation, then this is done, and we can move to the next topic rather than keeping this pending for many years. As I said, this is a 3-year cycle, so we try to be as predictable as possible, but preserving the agility needed in case something needs to be changed. And also for us, it's very important, and hopefully this is something that banks can actually perceive. The benefit of the planning we have put in place is that we are able to tell banks what is going to happen before the start of the supervisory cycle. So in the past few years, we have been able to share with the banks their own supervisory examination programs already at the start of the year. And the commitment for this year is to be even more efficient if possible and deliver this before the end of the year, which of course would not make necessarily less intrusive or less intense our activity, but at least banks can plan ahead and being aware of what is coming from our side. Thanks a lot.
Thank you very much, Mario. I see that the interaction here in the chat is going through the roof. So I see that the audience can't wait for our panelists to address their questions. So I may go directly to the chat then. And I would like to, we have a question from Nikolai Garchev, and perhaps this is a question for Martin. Would you be able to put a number in terms of basis points of CET1, capital for savings institutions, on the cost of compliance with an expanded regulatory framework? Martin, would you like to give it a go?
Yes, thank you very much. I think it's an excellent question, but it's very, very hard to answer. So translating regulatory burden into, let's say, CET1 costs is very, very complicated, and actually depends on, of course, a lot of individual factors on the bank level as well. But in our experience, regulatory costs make up around 1/4 of administrative costs. But, and that's a huge but, this is even higher for smaller institutions. So the smaller the bank, the higher is actually the proportionate burden on the bank, which of course makes sense because you have a lot of fixed costs in order to comply with new banking regulation, and be it related to CRD, CRR, or be it related to ESG regulation or whatever else there is. And I would also like to use this question perhaps as a just to sort of touch upon the whole issue of regulatory burden, as Björn already mentioned. And I think you have the capital or the administrative costs and the capital effects on the one side, but you also have an effect, something that is further complicating the situation, not just for the smallest banks, I think for every bank, which is that today we are confronted with so many different sources of regulatory guidance, so that even for regulatory experts, it's sometimes hard to tell which institution actually has the right of way on a certain issue in Europe. And there are just so many opinions, reports, guidelines, and Q&As, and actually more often than not, they unfortunately overlap. And so it's very hard to steer through that jungle of regulatory complexity.
Okay, thank you. Thank you, Martin. Next, we have a question directly for Björn from, this is from Jakub Lavrud. And Jakub is curious, which divergence between the ECB and Swedish financial regulators have the largest impact on the savings banks? Björn, would you like to go?
Yeah, I think there are some areas. One is that I mean, Sweden is a small open economy. We have 10 million people. What is an SME company in Europe is not an SME company in Sweden. It's totally different things. So the regulations sometimes they are tipping over from the European perspective into the Swedish sort of business models that we can't really handle it. I think that is one challenge. I think that we are ending up with more and more directives that are going to be implemented directly into Swedish law. That means that the savings banks have to be much more active on the European arena regarding to influence the decision making. We're not really prepared for that. That means that some of the directives that will be implemented, they are not really fit for the Swedish savings banks. So I think that is one area. I also think that if you look at the central bank specifically, we are the central bank, if I'm going to be honest, they are lagging a bit concerned ECB regarding, for example, crisis management, to foresee the need for alternatives when the digital solutions go down. That is in Sweden, meaning cash handling. That is responsibility for the Swedish Riksbank. And now we have had a situation where actually cash in circulation is only 1% of GDP. I think it's the lowest in the whole world. And that has meant, as we have increasingly problems with Russia, that we now have to reverse that trend. That's extremely cumbersome to get the customers to start using cash again. That is needed for security reasons in Sweden, but it is extremely hard to get it going. And the savings banks are the only banking group in Sweden that still handles cash on branches. All other banks have closed down. That means that it has to be handled via ATMs. So we have ended up in differences regarding ECB and the policies and the needs that are in place in Europe, and the Swedish central banks are trying to catch up. I think I'll stop there.
Okay, thank you. Thank you very much, Björn. This was a very, very important remark to take into account in the discussion. But let me now go back to some of the more emerging risks. Maybe this is a question for Mario. Could you please elaborate a little bit more on the geopolitical risks specifically? I think you touched upon it in your presentation, but you know, as everyone here has highlighted, there's a lot going on in that sphere, and I think would be really interested to hear how are banks currently assessing and managing the direct and indirect impacts of this, you know, the rising geopolitical tensions. You know, and this could be in the categories of either armed conflicts, sanctions, or potentially trade wars. So how do you see that being addressed on their credit and market risk exposures?
I mean, thanks a lot. I mean, if you allow me, I mean, first I need to say that this is a very interesting discussion, and it's not frequent to find such a lively audience. So it's good to, I mean, I think we have our script now, and we got a lot of additional questions, which I think is great. So I'm enjoying it. Then if you allow me a short response to the other speakers on complexity. Now, I will not be the one saying the whole European regulation, legislation, supervision is not complex, even though I remember one of my former bosses saying it's not complex, it's articulated. I would just like to make a quick point, which I think has been made by Sharon Donnery last week in a speech in Handelsblatt, underline that some of the complexities are, let's say, supervisors' fault, but also there is a big part of them coming from the requests of member states, the banking sectors, to reflect their own specificities in the European legislation. And this is not helpful. I think the way to go for simplifying would be more harmonization. If we keep having no option, national discretions, compromises for reflecting different needs, this is very often the source of complexity, and then the source of no Q&As, as you said, which are sometimes require a bit long time. But I think the effort should be from our side, but also from the banking sector, really in avoiding to request little changes for the sake of perhaps a few basis points of capital relief, and instead accepting the benefit of a simple framework, even though perhaps is a bit slightly more conservative for some jurisdiction. Now, on geopolitical risk, I mean, I will keep it short because it can take the whole webinar. But I think here we have been clear, and there's been already a couple of years ago, so well before changing the administration in the US, the geopolitical risk is becoming more prominent than in the past, because it's no longer, let's say, the traditional country risk, where if you want, you can avoid the risk just limiting exposures, but it's broader because it's not any longer so clear who are the friends, who are not the friends, and so where you can limit exposures. So the point is really to have enough awareness, have enough discussion in the banks, in the board, as part of their own, let's say, risk culture of the adverse scenarios, the potential reverse stress testing approaches to be used, and mitigating the risks, which can be financial risks in some banks close to the Russian border. In this case, can be operational risks to operational resilience. We have been clear as well that this is not a new risk, even if we call it geopolitical risk. It's really a trigger for traditional banking risks. And I think we've been also clear that perhaps there is no real need to reinvent the wheel, but we have already several provisions. If you think of risk culture, rules on outsourcing, rules on and guidelines on stress testing, on credit risk, loan origination, etc., which work very well for addressing the consequences of geopolitical risk. But it is important that the concept of geopolitical risk is really part of the reflection of the banks. And we have seen the different levels of maturity in banks. It depends also on the size of the bank, on how relevant the geopolitical risk is for them. But I would say there are two main categories. As I mentioned, there are some international banks with significant exposures in some countries, which they need to monitor, in some cases to vulnerable sectors. There are other banks which sometimes they are more local, less internationally exposed, but still in countries which are close to difficult geopolitical jurisdiction. So again, in this case, Baltic banks, for instance, the Nordic banks, where they feel very strongly about operational resilience, and also they are very much affected by cyber threats. So in this case, again, the kind of response can be very different. I mean, from our side, clearly the point is, let's once again, awareness, having this clear in the risk management, in the risk appetite, and having enough discussion at the board. But is where also we feel a bit more effort should be put. The first time we discussed this with our market participants, so to be fair, was not banks, was the analyst community, the investor community. We asked the question, what are you doing for geopolitical risk? And the answer was, we don't price it because it's, let's say, beyond what we can really price or be bothered about. Clearly, this is not enough. On the other hand, we also need to be pragmatic on our own expectations, because clearly there are some scenarios which can be addressed directly by the banks, some others which probably require a bit more collective response. Thank you.
Thank you. Thank you very much, Mario. And what I appreciate a lot is the bridge you've created from the geopolitical into the cyber risk. And here I would like to ask my last question this is a question for Björn and for Martin. So given the rise of these cyber incidents and reliance on third-party providers. What are the most common deficiencies that you see in your bank's operational resilience frameworks? And please make sure that your responses are choppy and short, because we're almost close to the end of the webinar. Very much appreciated.
I think that for us, I think it's about the lack of foresight and oversight. I don't think that you really have put all your effort in to understand the complexity with third-party suppliers. And to us, it is even more so because we have double outsourcing. First, we outsource to Swedbank, and Swedbank then have outsourcing agreement to the big players in the tech area. So I think it's extremely complex. I share the view that it is one of the most important things we have. We have had a number of attacks with malware. We have had phishing attacks, and we have had ransomware attacks that's been locking up sort of big data centers. So I think it's something to take very seriously. So I think it's lack of foresight and oversight.
Thank you, Björn. Martin?
Yes, just to keep it very brief, I think I agree with that, and also a lot of the focus, and I think that goes for every bank right now, is also on the issue of third-party risk management, and here DORA has been actually very helpful, but very ambitious, to say the least, as DORA has gone live on 17 January, but still a lot of the RTS and ITS specifications by the ESARs were finalized very, very late, or are still under finalization. And so also in particular in the area of third-party risk management, information registers, the guidance and the specifications have run so late that they created an additional challenge to keep up. We are keeping up. We are doing and giving our absolute best to work with the delays, and we have initiated work on the basis of consultation drafts and elsewhere. But still, this is very ambitious, and the same is also true for the area of ESG, where everyone's very eager to see the level 2 texts and trying to work with what's there, and everything in our view in these fields has become an area of moving target. Yeah, thank you.
Thank you, Martin. I still see that there's traffic in our chat inbox. Unfortunately, we're not going to be able to respond to everything. I hope the audience you understand. Maybe we'll have to start extending our webinars beyond 1 hour, or re-invite our speakers again for another session. But this has been a very, very nice discussion. And yeah, we're at the end of today's session. We really hope that you enjoyed this installment of the EBI policy series. I'd like to thank our guest speakers once again for this very, very intriguing discussion, very interesting presentations. And my colleagues at the EBI as well, everyone's worked hard to organize this event, and we truly hope that you've learned something new, and we hope to see you again soon. So thank you for your attention. Goodbye.
Thanks a lot. Bye.
Bye-bye.
Thank you. Bye.